Veidekke ASA is a leading Nordic contractor, presents a differentiated investment case characterized by exceptional financial prudence within a cyclical industry. The group's strategic evolution following the 2020 sale of its residential property development arm allowed it to streamline operations and accumulate significant capital reserves. This focus on core contracting and infrastructure operations across Norway, Sweden, and Denmark has resulted in highly efficient use of capital and a balance sheet that is profoundly robust. The central investment thesis is underpinned by Veidekke's formidable financial strength, specifically its large net cash positive position, which provides an uncommon degree of safety against macroeconomic volatility and guarantees the sustainability of its shareholder distribution policy. Although simple earnings multiples, such as the price-to-earnings ratio, ranging from 16.6x to 17.1x, suggest the stock trades at a slight premium compared to its 5-year median of 14.7x, a deeper analysis using enterprise value (EV) multiples reveals a substantial undervaluation of the core operational assets. The reported LTM EV over EBITDA multiple of approximately 6.78x is substantially lower than that of its major Nordic peers, suggesting the market has not fully integrated the intrinsic value and financial flexibility conferred by the net cash reserves into its valuation of the operating business. Veidekke maintains a highly aggressive dividend policy, aiming to pay out at least 70% of post-tax profits. Historically, this commitment has materialized in a 5-year average payout ratio of 96.67%. While such a high ratio would be concerning for most firms, the dividend's safety is conclusively validated by the company's consistent generation of operational cash flow and, critically, the 2.7 billion net cash reserve. The structural superiority of the balance sheet provides a strong financial grade, leading to the conclusion that Veidekke is a highly appealing option for investors seeking reliable, well-protected, and high-quality dividend income within the industrial sector. Corporate and operational context, strategic position and risk mitigation. Veidekke's current operational framework is that of a diversified, focused contractor. The group undertakes all manner of building and civil engineering projects, alongside essential road maintenance and the production of asphalt and aggregates across its primary markets of Scandinavia. The strategic sale of the residential development business 5 years ago allowed the company to pivot towards a streamlined contractor model, emphasizing operational execution and capital distribution. Operational momentum and revenue visibility. The group's near-term stability is anchored by an exceptionally strong order book. As of the third quarter of 2025, the order book stood at a robust 47.5 billion. This represents a material year-on-year increase of 16% from Q3 2024, providing significant visibility on future revenue streams. Management forecasts that 27.2 billion, approximately 57% of this order book, is scheduled for delivery and revenue conversion within the subsequent 12 months, indicating a clear trajectory of high, predictable activity levels. Operational performance has been strong, particularly in core geographical areas. In the third quarter of 2025, the group reported 10.7 billion in revenue, a 10% increase compared to 9.7 billion in the third quarter of 2024. Key performance drivers included high demand and activity levels for Infrastructure Norway's asphalt operation and robust order intake for Construction Norway and Hoffman in Denmark. While the broader Scandinavian construction market is anticipated to see a slight contraction in 2025 before resuming growth in 2026 and 2027, Veidekke's strong order reserve and focused execution provide a crucial buffer against immediate cyclical slowdowns. Margin performance and project risk management. Veidekke has demonstrated superior execution and margin defense, a crucial sign of operational quality in the contracting business. Despite the challenging macro environment, including higher interest rates and inflationary pressures, the group achieved total pre-tax profit of 1,683 million in 2024, a notable 17% increase from 1,444 million in 2023. Furthermore, the overall profit margin improved in Q3 2025 to 6.8%, up from 6.4% in the corresponding quarter of 2024. A significant portion of contracting work, particularly in infrastructure and large-scale buildings, is often executed under fixed-price contracts. This contractual mechanism inherently transfers significant financial risk related to unexpected cost increases, material shortages, or scheduling delays from the client to the contractor. The capacity of Veidekke to not only maintain but actually expand its profit margins during a period of sustained inflation demonstrates disciplined project selectivity, effective procurement strategies, and well-managed execution. This successful margin defense serves as a tangible validation of management's assertion that project risk is under control, affirming the high quality of the order portfolio and the operational maturity of the organization. Analysis of financial stability, the balance sheet assessment. The Veidekke balance sheet is structured to withstand cyclical pressure, characterized by a unique capital profile, uncommon among major industrials. Capital structure and leverage profile. The most salient feature of Veidekke's financial structure is its substantial net interest-bearing asset position. As of 30 September 2025, the group held net interest-bearing assets totaling NOK 2.7 billion, an improvement from NOK 2.1 billion reported 1 year prior. This means Veidekke functions as a net creditor, accumulating financial assets faster than debt, thereby eliminating net financing costs and providing a substantial liquidity cushion. This structural net cash position immediately neutralizes traditional leverage concerns. Veidekke's financial policy targets maintaining net interest-bearing debt over EBITDA, NIBDA over EBITDA, below 3.0, but as of 31 December 2024, the positive net interest-bearing position of 2.6 billion rendered this ratio inapplicable. Further evidence of minimal financial risk is provided by a very low total debt-to-equity ratio of 7.57%. The company strategically manages its financing solely through the bank market, utilizing a 2 billion overdraft facility with DNB and a 1 billion credit facility with Nordea, both refinanced in February 2025. This deliberate absence of outstanding certificate or bond loans underscores a preference for flexibility and robust liquidity management.
Capital efficiency and the high return on equity. Veidekke operates with a reported equity ratio of 16% as of Q3 2025. Typically, a low equity ratio suggests high financial risk. However, Veidekke pairs this ratio with an exceptionally high TTM return on equity, ROE, reported between 47% and 48%. This combination is not a sign of excessive risk-taking, but rather an outcome of the operational model. The contracting business model frequently involves taking substantial advance payments from clients, which are recognized as short-term liabilities. This client capital is used to finance operations, effectively substituting for permanent equity capital. This mechanism minimizes the required equity base, the denominator in the ROE calculation, while profits remain stable, structurally boosting the calculated ROE. The consistently high ROE, therefore, confirms the inherent capital efficiency of the Veidekke model, where clients, not permanent shareholders, provide a large portion of the working capital necessary to execute projects. Liquidity and the working capital cycle. Standard industrial liquidity metrics, such as the current ratio, can be misleading for contractors. Veidekke's current ratio is reported to be low, fluctuating between 0.76 and 0.82. For most businesses, a ratio below 1.0 would signal potential short-term solvency issues. In Veidekke's case, this ratio is the result of a deliberate and highly effective negative working capital cycle. Current liabilities, which stood at 13.3 billion in the latest reported quarter, are dominated by customer advances and deferred revenue. These liabilities reflect cash received from clients before the work is completed and invoiced, meaning Veidekke uses client money to fund its current asset base. The higher the ratio of client-financed liabilities to current assets, the lower the calculated current ratio. The fact that the company can maintain such a low current ratio while simultaneously holding a net cash position of 2.7 billion is the definitive evidence of a successful cash conversion cycle. This cash hoard is the accumulated product of efficient project execution and the favorable negative working capital dynamic, proving that liquidity is not compromised despite the low headline current ratio.
Cash flow dynamics, statement of cash flows review. A detailed examination of the cash flow statement reveals the inherent seasonality of Veidekke's operations and the recent success in driving cash conversion. Operational cash flow trends and seasonality. The company's cash flow exhibits pronounced seasonality typical for Northern European construction firms. Management has noted that capital is generally bound in operating capital during the first half of the year, H1, as projects commence, with strong cash generation typically reversing this trend in the third and fourth quarters, Q3 and Q4. Reviewing the historical performance, cash flow from operational activities (CFO) for the full year 2024 was reported at 2.2 billion, marking a decrease from 2.9 billion in 2023. This temporary contraction was attributed to reduced activity levels late in 2024 and resulting lower capacity utilization. However, the most recent reporting demonstrates a sharp recovery in cash generation. For the first 3 quarters of 2025, cumulative CFO reached 1.8 billion, a significant increase compared to the 1 billion generated over the same period in 2024. This acceleration in operational cash flow is a critical indicator. It demonstrates that the improvements in capacity utilization and increased turnover, which led to improved reported profits, are successfully translating into tangible, realized cash. This robust cash conversion is essential for a business model that relies on internal financing capability, and it directly underpins the ability to maintain the high dividend payout. Free cash flow quality and deployment. Veidekke exhibits strong quality in its free cash flow metrics. The reported levered free cash flow (LFCF) for fiscal year 2024 was approximately 1.51 billion, with an LTM FCF reported as high as 2.32 billion for the period ending September 2025. These figures confirm that Veidekke's core operations are highly cash generative, comfortably exceeding the capital required for maintenance and growth investments. Veidekke's stated capital allocation strategy places primary emphasis on funding operational investments and providing high shareholder returns through dividends. Share repurchases are considered only opportunistically when the stock price is deemed materially below intrinsic market value. The sustained strong FCF profile ensures that the company can simultaneously meet its capital needs and execute its attractive dividend policy without compromising its substantial cash buffer. Dividend policy and safety assessment. The commitment to shareholder returns through dividends is central to Veidekke's equity story, validated by structural financial characteristics that mitigate the risks typically associated with high payout ratios. Dividend commitment and payout analysis. Veidekke operates under a highly transparent and generous dividend policy, mandating the payment of dividends equivalent to at least 70% of post-tax profit. Reflecting this commitment, the company distributed a dividend of 900 data per share for the financial year 2024. When measured against the corresponding profit per share, EPS, of 9.30 for 2024, this distribution results in an aggressive payout ratio of nearly 97%. This level is consistent with the firm's operational history, evidenced by a 5-year average payout ratio of 96.67. The dividend itself has exhibited consistent growth, increasing from 775 øre in 2022 to 900 øre in 2024, demonstrating management's confidence in sustained profitability and cash generation. This high payout ratio translates directly into an attractive dividend yield for shareholders, currently reported in the range of 5.36% to 6.1%.
Sustainability. Ordinarily, a payout ratio nearing 100% of reported net income would raise serious sustainability concerns for investors, implying minimal retained earnings to absorb unexpected losses or fund growth. However, in Veidekke's case, the financial structure validates this high distribution for several critical reasons. Earnings quality and FCF coverage. The dividend is amply covered by consistently strong free cash flow, which stood at 1.51 billion LFCF in 2024. Cash flow coverage is a more rigorous measure of dividend safety than net income coverage, especially in industries where accounting depreciation or other non-cash charges can impact statutory profit. Order book stability.
The predictability provided by the NOK 47.5 billion order book significantly stabilizes future earnings expectations, mitigating the risk of a sudden, sharp earnings collapse that would challenge the dividend commitment. The net cash guarantee. The existence of a substantial NOK 2.7 billion net cash position fundamentally de-risks the dividend. This cash buffer can serve as a potent financial reserve, enabling Veidekke to sustain its targeted payout ratio, even if operational earnings temporarily dip below the required coverage during an economic trough or due to a large unforeseen project loss. This reserve ensures that financial resilience and shareholder returns are maintained simultaneously. By sustaining a payout ratio close to 100%, management sends a powerful signal that Veidekke's operational needs are largely met through its highly efficient client-financed working capital cycle. This means the majority of statutory earnings are not needed for internal reinvestment, confirming they are surplus capital available for immediate distribution to shareholders. VI, current valuation and peer relative benchmarking. Veidekke's valuation is characterized by a dichotomy. The stock appears fairly valued to slightly expensive when viewed through standard earnings multiples, but is demonstrably undervalued when measured against operational cash flow and accounting for its unique balance sheet structure. VIA, earnings multiples, PE ratio analysis. Veidekke's latest 12 months LTM price-to-earnings ratio is reported between 16.6x and 17.1x. This valuation is elevated compared to the company's 5-year median PE of 14.7x, and noticeably higher than the broader Norwegian market, where PE ratios below 12x are common. When comparing Veidekke to its major Scandinavian peers, the PE ratio aligns closely with market leaders, trading at 16.6x compared to Skanska AB at 16.4x and Per Arslef Holding AS at 16.0x. However, it trades at a premium to NCC AB 13.4x and PAB AB 13.9x. The premium PE multiple is noteworthy, especially considering analyst forecasts for Veidekke project only moderate EPS growth of 5.5% annually over the next 3 years, significantly lagging the estimated 23% average annual growth for the market. The continued valuation premium assigned by the market is a clear indication that investors are pricing in the stock's low systemic risk, consistent profitability, and a high-quality, dependable dividend yield, rather than anticipating aggressive top-line growth. VIB, enterprise valuation multiples, EV by EBITDA, unlocking hidden value. For companies with substantial cash reserves, the enterprise value, EV multiple, which values the operating business excluding cash and non-operating assets, provides a more accurate measure of the intrinsic value of the core operations. Veidekke's net cash position results in a net debt figure that is negative, significantly depressing its enterprise value below its market capitalization. This calculation leads to an extremely attractive LTM EV by EBITDA ratio reported at approximately 6.78x. This operational valuation stands in sharp contrast to the company's peer group. Skanska AB trades at an EV by EBITDA multiple ranging from 11.2x to 12.5x, while key competitors like NCC AB, PAB AB, and Per Arslef Holding typically trade in the range of 7.9x to 8.7x. The gap between Veidekke's 6.78 and the peer group average represents a material embedded discount to the core operating business. This pricing differential exists because the company's large cash reserves inflate the market capitalization, the numerator in the PE ratio, while simultaneously reducing the enterprise value, the numerator in the EV by EBITDA ratio. Consequently, the core construction and infrastructure operations of Veidekke are effectively purchased at a significantly cheaper multiple than those of its competitors, presenting a clear opportunity for patient investors. VIC, price targets and market sentiment. The price-to-book ratio for Veidekke is structurally unreliable for deep valuation analysis due to the low equity ratio driven by the client-financed operating model. The high ROE, 47%, ensures that the book value consistently fails to reflect the company's strong earning power. Current analyst consensus reflects the mixed valuation signals, generally maintaining a neutral rating.
The average 12-month price target is approximately NOK 169.83, with forecasts ranging from a low of NOK 151.5 to a high of NOK 194.25. With the stock trading near NOK 167 to 169, the consensus suggests that the current market price reflects the stock's fair value based on known fundamentals, but it requires greater clarity on accelerated growth or a greater appreciation of the EV discount to warrant a strong buy recommendation and a significant increase in the price target. VIA Final Conclusion. Veidekke ASA is assessed as a high-quality contractor offering exceptional financial safety and reliable market-leading dividend income. The comprehensive analysis of its financial statements reveals a structurally superior capital position defined by a substantial net cash positive balance, NOK 2.7 billion, and a highly efficient client-financed working capital cycle. The rebounding operational cash flow in 2025 and the massive visible order book of 47.5 billion confirm the operational stability required to underpin the group's aggressive payout commitment. From a valuation perspective, Veidekke's PE ratio suggests fair pricing based on risk-adjusted quality. However, the operational assets are currently priced at a significant discount, evidenced by the compelling EV by EBITDA multiple of 6.78 compared to the sector average, which is driven by the exclusion of the large net cash reserve from the enterprise value calculation. This discounted operational valuation, coupled with the security provided by the net cash buffer, positions Veidekke as a highly compelling investment for income-focused portfolios within the Nordic industrial space. VIB Key Risk Factors. While Veidekke demonstrates strong financial resilience, investors must monitor the following industry-specific risks. Fixed-price contract execution risk. Veidekke's continued success in expanding margins relies heavily on superior execution and effective cost control, especially given the prevalence of fixed-price contracts in the industry. A sustained, unexpected surge in input costs, materials, energy, or labor could rapidly erode margins across the large order book, potentially requiring the use of the net cash reserves to cover losses, thereby testing the safety of the current high dividend payout. Working capital cycle reversal. The foundation of Veidekke's capital efficiency is the negative working capital cycle, primarily relying on customer advance payments. Any market shock that causes clients to delay payments or reduce advance funding, or regulatory changes that restrict this practice, could necessitate higher external financing and reverse the strong operational cash generation trend, placing strain on the balance sheet. Cyclical industry exposure. Although the substantial order book shields near-term revenue, the Scandinavian construction market is inherently cyclical. If the anticipated market growth recovery projected for 2026-2027 is delayed or proves weaker than expected, Veidekke's new order intake could slow, leading to reduced capacity utilization and eventual pressure on profit margins.